And so we're going to look at the disposal of it. So disposal can mean three things. So when an asset's no longer useful, there's three things we can do. We can discard it, which is just outright getting rid of it, scrapping it. We can sell it, or we can trade it. We have to take out the book value, which means we have to remove the asset. So for instance, truck under our assets account, and we have to remove the accumulated depreciation for that truck. And we have to catch up our depreciation. So if we do depreciation up through December 31st, 2012, and we sell it on February 2nd, 2013, we have to account for depreciation from December 31st to February 2nd to catch it up. So the first example is discarding it, so it has no value to you, you can't sell it. So an IBM computer from 1982, it's not useful to you, and you're not going to be able to sell it to anybody. So here's an example, a $25,000 fixed asset that's fully depreciated, and we're going to discard it. We're just going to get rid of it. So we're going to take $25,000 out of our equipment account because we're getting rid of it. We don't have it anymore. And then we're going to reduce accumulated depreciation by $25,000 because we already depreciated $25,000 for that equipment. We don't have the equipment anymore, so we have to get rid of the depreciation that we already recognized for it. So basically, there has to be no trace of that equipment on our balance sheet, either in the equipment account or the accumulated depreciation account. It's all got to go. Here's another example. So we're going to look at a $6,000 fixed asset. We have $4,750 of depreciation on December 31st. We're going to discard it in March. So the first thing we have to do is we have to recognize depreciation from December 31st through March. So that's $150. Accumulated depreciation, depreciation expense. And then we're going to get rid of the asset. So we're going to reduce equipment by $6,000 because $6,000 asset, we don't have it anymore. We have $4,900 of accumulated depreciation we're going to take off our balance sheet too, which is the $4,750 plus the $150. The other side of the last part of the entry to make it balance is we're going to show loss on disposal of equipment as an expense on our income statement and then reduce retained earnings. So this makes sure that our accounting equation still lines up. Another thing we could do is sell fixed assets. So it's similar to the discard, but we also have to record cash collections. And you can record a loss or a gain in selling assets, depending on what it's worth and just depending on what you sell it for. So we're going to look at a sale here where equipment costs $10,000. It's depreciated at a straight line rate of 10%, which is $1,000 a year. We're selling it on October 12th of the 8th year. So accumulated depreciation at the end of the previous year, which is the end of year 7, is $7,000. First thing we have to do is recognize 3/4, 9 months of depreciation this year through October 12th, which is $750. So January through the end of September to get us into October is 9 months. 9 months over 12 months is 75%. 75% of $1,000 is $750. This is the prorated amount of depreciation for the year. So for a full year, we recognize $1,000, 10% of $10,000. 75% of that is $750. So our accumulated depreciation after we add the $750 is $7,750. $7,000 plus $750. The book value, we take our original cost of $10,000 less the $750 accumulated depreciation. Our book value is $2,250. So here, let's just say we sold the asset for $2,250. Cash is coming in the door. For $2,250, we increase our asset cash. We're getting rid of equipment that's at a cost of $10,000, so we reduce our equipment account by $10,000, and we have to take the associated accumulated depreciation for that equipment off too, for $7,750. and there's no gain or loss because we're selling the asset at book value. Here, let's look at the assets sold for $1,000. So we increase cash by $1,000. We reduce our equipment account by $10,000. We reduce accumulated depreciation by $7,750. But then we're going to show a loss on the disposal of equipment as an expense on our income statement for $1,250. And then we reduce retained earnings by $1,250. So the difference between the book value and what we sold it for is $1,250. So the selling price was $1,250 less than book value. Therefore, we show a loss on the sale of equipment. So here we're going to sell it for $2,800. We increase cash $2,800, cash coming in the door. We reduce equipment by $10,000. We reduce our accumulated depreciation. But since we sold it for $550 more than the book value, we're going to show a gain on disposal of equipment of $550 as a positive on our income statement. Therefore, we increase retained earnings by $550.